Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome James Pappas. Thank you, James, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks, Greg. I'm looking forward to the discussion today.
Me too. James serves as the managing member of JCP Investment Management, LLC, an activist investment firm he founded in 2009. He has sat on 9 public company boards, including Jamba Juice, United Natural Foods, U.S. Geothermal and The Pantry, by way of example. He serves on 3 public company boards today and several private company boards. Prior to JCP, James worked at Goldman Sachs and Bank of America. So this is another activist investor. This should be interesting just to see the different perspectives that James brings to the discussion. So first of all, let's open up with a question. What is your background and how did it prepare you for being an activist investor?
Sure. Thanks, Greg. So I grew up here in Texas, originally from Houston. I ended up going to school here in Texas, and my undergraduate was actually in information technology. And so I ended up with finishing that a little bit early, but wanting to stay in college for a little longer, as most of my friends were. And so I ended up doing a graduate degree in finance, and I ended up in New York at Bank of America in the consumer and retail group. And then I shortly thereafter, I ended up at Goldman in their consumer and retail leverage finance group, focused on consumer and retail companies. As a side note, my family's been in the food and restaurant business and real estate business going back 100 years here in Texas. And growing up in the business, I just knew as a young kid that I loved it. 10 to 22, working in the back of the stores, starting out as a prep cook, and then at 14 being a busboy, at 16 being a host, and then being a waiter, and then finally a cook on the line, which was by far my favorite job when I was in college from 20 to 22. And so I knew I wanted to follow that when I went into finance. And so I decided to cover those companies. And so within consumer and retail, I sort of specialized around restaurants and got to spend a bunch of time with management teams and whatnot. And then finishing that up in June of 2007, I decided, okay, I didn't want to stay in New York anymore. I love New York, love it as a city, but knew I wanted to get back here to Texas. I have a big family back here. And so I decided to take a little bit of time off. And then shortly thereafter, in 2008, the world proceeded to fall apart. And so as a young, somewhat naive individual, I went around and begged people for dollars, ended up starting the firm in June of 2009, which was a great time to be investing, horrible time to be asking people for money. And so shortly thereafter, I got my first fund going. And from there, world kind of went multiple different directions. I don't know if I'm happy to dive into things further from there, but I don't know what direction you'd like to take it, Greg.
Yeah, no, that's good. I mean, I guess, from you didn't set out really to be an activist investor to begin with. You just set out to be an investor.
Exactly.
How did that transition happen? How did you actually become more active in your investing?
It's a great one. So in 2009 through 2011, we made a handful kind of concentrated investments, and my focus being around, at the end of the day, I'm an entrepreneur just looking to buy into companies and make them better. And in 2011, in August of 2011, we bought 15% of a public company out of Ohio. And we bought the shares from a failing private equity firm. And I got to know the CFO decently well. And in February of 2012, he called me and said, "Hey, do you want to come on board?" And I said, "Okay, I'm going to try this out." And at the time, we were managing a relatively small amount of money. And so I went on the board, and I realized very quickly, it happened to be a restaurant company. I realized very quickly that they were having financing issues. They were a franchisee of KFC's and Taco Bell's. They were having franchisor issues. Frankly, the franchisor was asking the company to put capital into stores that really was not a good return for the company, but it would have, potentially increased revenues a little bit, but it was not a good return for the company. And then the financing was an issue. Within 9 months, the board realized that I was very passionate about getting to the right place and had some great contacts. They made me chairman of the board. At the time, I want to say I was 29, maybe 30 years old.
Mm-hmm.
And over that 3.5 year period, we went from shareholders, obviously including myself, since I entered the board, we made 14.2 times our money.
Wow.
And I got to know the COO, the CFO, the CEO. We became very close. I still have relationships with him today. Every board member that didn't know me before I went on the board, and by the way, they asked me to come on the board in that particular case. And frankly, in several boards since then, people have reached out and said, "Hey, do you want to come onto the board?" And so, I really, from that moment on, I decided, I did not come from a big activist shop or anything like that. The way I looked at the company was very simply, I felt it was a great investment. I felt I could make a difference and help
Mm-hmm.
them go from A to B, and that's what happened. And so, as that process went along, I realized that I think I'm going to do this for the rest of my life. And that's kind of how it all started.
Do you think the transition was easier than it might have been because one of your early investments was in the restaurant business, which you knew so well from your family experience?
It was a huge help. And definitely from my B of A and Goldman experience, just for instance, this company was having a financing issue. The story goes, the CFO called after I had been on the board and said, "Hey, we went to this particular commercial bank. They said, everything kind of checked out, but we're not going to make the loan." And I said, "Well, give me the guy's phone number and name that is in charge of the underwriting. I'd love to just call him and hear his thoughts on why no." We talked for about an hour, and he said, "You know what, James? Give me an hour or two. Let me go talk to my credit officer and come back to you." Sure enough, he came back to me. They refinanced the loan out of a very bad interest rate term loan, and we got into a great loan. I think there was that mix of, I knew the business, but I also knew the capital structure,
Mm-hmm.
and he could tell that there was an understanding that, hey, this person is a significant owner in the company. This person wants it to work out. We now have somebody that we feel is pushing in a direction with alignment with us. We're
Mm-hmm.
willing to underwrite at that point. And
Hmm.
so if I had been going in to say, a consumer business that wasn't restaurants, or a retail business that wasn't restaurants, or even, if it was another area, like we've been on, power company boards, we've invested in waste companies and whatnot. Restaurants is really the only area where I can traverse both. I can
Mm-hmm.
traverse both operations and the financial side of things relatively easily.
Hmm. Yeah, that's great. By the way, I meant to say it earlier, but just a little plug for your family business. I spent a lot of time covering energy, so I spent a lot of time in Houston, and being in Houston, there are a whole array of your family's restaurants there, which I visited over time, and they're very good. The Pappas Steakhouse, Papadou is really probably one of my favorites. I think it's better than a lot of the food you have in New Orleans,
Gotta
which
love
is
that
pretty good.
Cajun. Yeah.
The one at the airport too. So anyway, just a little nod to your family. They're really great business.
No, thank you. I mean, my dad and my uncle love what they do. They're passionate,
Mhm.
and they have an incredible team. And I'll talk about how I think about team later, which is
Mhm.
number one for me. Right people in the right seats. That is how you push things along correctly.
Yeah, yeah. So you've worked with quite a few companies now. You've been on the board of many. Some you've just been an investor, not on the board. If you had to generalize, what do managements most frequently get wrong? What are the biggest, one or several things that they do wrong that you see from your seat?
Yeah, um, I might answer that question in a different way if that's okay.
Yeah, sure.
So I think what happens to some public companies over time is they start to lose focus around what is important, right? And they start to drift into areas that really don't generate a whole lot of value for any of the stakeholders,
Mm-hmm.
meaning the employees, the shareholders, the community, their customers. They start to lose that, what is most priority, right? And yeah, I think it's incredibly important that the customer always comes first. The value being driven for the customer will, at the end of the day, drive value for all the other stakeholders. I think that's key. That you can't not think about the other stakeholders, though. You have to make sure everything's being lined up.
Mm-hmm.
And so I'll give you a couple of examples. Many times it happens where you have a company that's had, say, 5 CEOs over 10 years. You have strategy shifts over those 5 or 10 years, over those 10 years amongst those 5 CEOs. Unfortunately, what you also have is you have the customer who many times, when you're switching strategies that much, they also tend to lose where the value is in the product or service that company is providing. And
Mm-hmm.
then from the employee base standpoint, they start to lose, hey, what are we here for? What are
Right.
we trying to do? What's the accomplishment we're trying to have?
Mm-hmm.
We see that so often within a company, that loss of focus.
Mm-hmm.
I'd say that's a handful of items that fall into the number one bucket, is just this turnover of team and this lack of clarity on strategy.
Mm-hmm.
The second piece is the capital structure. Many times what we find at the board level, and it seeps into management teams, is there's really very few people that have long experience dealing with investing, and it's all at the same time. It's not just one of the pieces. It's
Mm-hmm.
investing in the equity, investing in debt, how the capital markets work, how all that comes together, what is the right amount of leverage, if leverage should be used at all.
Mm-hmm.
All that within sort of the capital structure component. A management team, many times, they don't have experience in that.
Mm-hmm.
They don't have experience in that. They don't have, and that's okay, right? That's okay. They should be able to lean on people that do. But unfortunately, we find that they don't have those people many times that are aligned in the right areas. So
Mm-hmm.
between those two pieces, we find those to be two areas where we can be very, very helpful. In the first area, we can be very, very helpful in providing stability and the right people in the right seats, and really being insanely supportive of the management team in any way we can, right? Whether it's
Mm-hmm.
me on the board, or it's somebody from my firm, or it's somebody that we're putting on the board. That's an area that we can be stabilizing when it comes to strategy and team. The second area being the capital structure. That's going to be an area that we get, very, very involved in, and try and bring as much value as we can.
Yeah, that's fascinating. On both points, I've had so much experience with what you're saying. On the first one, you started with, you got to think the customer has got to be the focus, and then obviously all the other stakeholders as well, and maintaining what do we stand for, what differentiates us from others. I have an interesting thing I've been doing for years when I meet a new company, and when I meet a new CFO in particular, when I ask the question, what really differentiates your company from your competition? Sometimes people just look at me like I have four heads, like ask marketing, and
It's
but
crazy.
you're a member of senior management. That should just roll off your tongue, right? Because if you're
100%.
not conscious of that, then you're probably going to jeopardize it, right? You're going to cut some cost that's going to jeopardize the technology edge or the quality edge, or whatever it is that makes your product or service unique.
Look, one thing I'll say is, we love to, right when we start meeting with a company, whether it's a private company or a public company, the first thing we start talking about is the landscape, right?
Hmm.
Talk to us about the industry. Talk to us about what your peers are doing, what your competitors are doing. Maybe there's a peer or competitor that's doing something that you find, really, really innovative,
Hmm.
and that you're following pretty closely. Like that, that's a discussion we absolutely love to have.
Hmm. Hmm. Yeah, no, that's great. And on the leverage, for many years I've thought that the development of an optimal cost of capital analysis years ago, where every company should be just barely not investment grade. has led so many companies to be over leveraged and to miss great growth opportunities, or to jeopardize the viability of the company in ways that they never needed to. As I said before, I spent a lot of time in energy. The volatility of the commodity price is so significant, and yet you have a lot of these companies have a lot of debt. I just don't get it. It's
I think you hit on the nail. There's an outside external force for companies. Many times that's what is sort of like the mantra either at the time or for that particular, it could be a particular industry.
Mhm.
And, this discussion of, well, you should have at least debt to EBITDA 1.5 turns, or you should have X amount of debt relative to cap structure. I just don't. I'm always going to know what those things are, right? But that shouldn't determine how much leverage you're using at all times. It
Right.
just shouldn't. And for smaller companies, 2 turns can turn into 4 real quick,
Yeah.
right? And 2 turns of debt to EBITDA might not be what free cash flow is, right? And then all of a sudden you're talking about a completely different ratio or
Sure.
situation.
Sure.
So
Sure.
yeah,
Yeah. Yeah. So some activists are more focused on cost cutting and
sure.
business transformation, but you're more of a growth activist. What does that mean? And is it just organic growth, or are you sort of pro acquisition as well?
Sure. So I'll put it in a couple of buckets. I think there's the first bucket, which is, a shareholder buys shares in a company and would like the company sold, right? And that's sort of like the message, or largely the message. That's sort of M&A activism, if you will. And
Mhm.
then you have sort of somewhere in the middle where you have kind of M&A plus growth, et cetera. And that's interesting, where you have opportunities to spin off companies and whatnot from an initial parent company. But for us, we do not focus. It's M&A is just not an absolute focus for us. The number one
Mhm.
thing for us is earnings growth over a long period of time, right? And the only way you're going to get that is by good growth. And the
Mhm.
only way you're going to get good growth is by having the right people in the right seats who can go after that growth, right? That means at the board level, that means at the management level. And
Mhm.
so for us, as we're looking at a company, we're saying, okay, let's think about what does this industry have today? Where's the industry moving? And it doesn't necessarily mean that the industry has to be moving up and to the right. It just
Mhm.
means understanding what's happening in the industry as far as growth, who's doing what, right? And who's winning and who's losing and by how much, right?
Mhm.
And then once you can determine that, you can determine how that affects the company that you're looking at from an organic standpoint. What are their opportunities for organic growth? It might not be available to them at the moment, but it's
Mhm.
something that we can help them get to, right? A new organic opportunity, or just frankly pushing organic opportunity even farther, giving the management team a cheerleading squad to say, hey, this is an opportunity. You have the capital or you have the wherewithal to do it. Let's go after it, right?
Mhm. Mhm.
I mean, non-organic is can be a very good growth option. It's somewhat secondary. You have to be careful with it, right? You
Mhm.
have to be careful with how you use non-organic, and how do you deal with the capital structure and all the sort of things. And then you have, obviously, with the non-organic side, is integration over the coming years as you're
Mhm.
pulling that off. You need to have set processes in place as new people and new assets come on board for the company. Some companies just don't have that muscle, because it
Mhm.
really is a muscle,
Yeah.
and it's a muscle on both sides, right? Some companies have the organic muscle. Some companies don't. They're just not set up at the time that we enter to have growth,
Mhm.
and that takes, it's like I always say. I mean, with a new CEO or a new executive in general, at a minimum, they should have 18 to 24 months to start to show some green shoots of some kind,
Mhm.
right?
Mhm.
You might not see them at that moment, but
Yeah.
you need to give them time to do that. It's the same thing about these muscles for growth or for non-organic, is you might have to help put them in place. And
Mhm.
that, look, that's not easy. That is a lift. And that's really, to circle all the way back around to your question of growth activism. What is it? It's that, right? It's getting those muscles working so that the company can grow. And it might take even a little longer between 2 and 3 years. If you have a capital structure that you need to fix, right? Many times we might be investing in companies that I was a leveraged finance banker at Goldman. I feel strongly that if there's a good business, a core business, but the capital structure is upside down, we have a number of ways that we can help fix that situation. And if we can do that, and usually we can get that done within the first 12 months. It's after that that we start working that organic muscle and that non-organic muscle.
Yeah. One other investor said to me and that's a similar question, not in a podcast, but he said the problem is it's hard to tell somebody to go do an acquisition because it's like you're taking the burden off of them. Well, you told me to do that. He said, I'm supportive of good acquisitions where they have a good plan and I think they can integrate and there's value to be had at a good price. But he said to go in and push for it is just asking for trouble because, then you've taken all the responsibility off of them because if it goes wrong, they can just blame it on you. So, yeah, I get that. But as far as organic growth, I mean, I think that's one of my pet peeves. My book is Curing Corporate Short-Termism, and a lot of it's about how many large companies are way under investing in the future, relying on acquisitions for growth, and it's really the organic growth that's most valuable in most cases. And they don't take risks anymore. They're not innovative. They're not, they're just everything is about scale, and oftentimes if they had a great brand 20 years ago, the brand strength has been slowly, petered away as they've gone through more and more channels that are less and less exclusive. So anyway, it's the growth muscle is it's a good thing that a lot of companies can use. It's good to have people like you pushing them.
One thing that you touched on there, which I think is hugely important, is I'm not a big fan of, especially when I'm on a board, I'm not a big fan of you must go do this, right? I'm a big fan of being in a position to have the right research done and to assess an opportunity. And then I have to have the CEO on board with that opportunity. You cannot tell the person, go do an acquisition. It doesn't work. It never works that well. You can't tell them to go do the organic. They have to be passionate about it, right? They have to say, I want to sign up to this. I'm going to work really, really hard. I want to go for it. You cannot tell them to do it. It doesn't work. And the other piece of that is I think there's a misnomer, and we can talk about this later, but I do think there's a misnomer within the world of activism, of, kind of, trying to beat somebody over the head to do something. It never works. And the only thing that works is you have to remain extremely professional in the boardroom. I say that all the time in the boardroom. If somebody is being unprofessional, that does not build consensus, and then that does not move the company forward, and you don't get the organic growth and you don't get the non-organic growth, whatever it may be, because you're trying to tell somebody what to do. Instead, they should get on board or not get on board if they have a better idea. Our ideas aren't always the best ideas when we insert ourselves into the boardroom. I'm happy to be wrong, because once I'm wrong on something, I'm fully in on the next thing.
Yeah. By the way, the same thing works inside of companies. A lot of CEOs tell their business unit leaders what to do, and in the same way, it's taking the onus off of them, to be responsible.
Yeah.
All right. So recently, when we spoke, you said something I thought was just a fascinating sequence of words. You said you contrasted a good investor that's a bad activist versus a bad investor that's a good activist, which sounds really interesting, and I'd like to have you explain what
Sure.
you mean by that.
Sure. So I've been doing this for 15 years, so I've seen investors and activists go kind of in and out of the capital markets. And one thing that I've noticed is that there are some investors that are very good activists. They have the ability to go out, buy stock, and then get onto a board, but the underwriting might not have been sound at the beginning. And you kind of see it over and over again. And I think the piece that I always look at is when you set out to do your underwriting, did you think to yourself, okay, if I own these shares but didn't make any changes in the company, how would things go? Right. And then if I do make the changes that I think, or I do get involved with the company, what is the incremental time and return to investors over that time period? Can I make a difference, and does that make a difference in the potential outcome? So that's sort of the what, and I've seen that happen just over and over again over 15 years. Is, somebody gets onto a board, but the underwriting at the beginning was not where it should have been. But they were so excited about being a part of the company that they went ahead with it anyway. Anyway, so that's one piece of it. The other one, which is good investor but bad activist, that really means somebody that knows how to underwrite. They've done a good job on the underwriting, but going from being in a seat of I bought the stock to I'm on the board helping the company move forward, there's a wide space between those two places. And I found that there are some folks that have a hard time from going from A to B. And that it's a mix of, well, number one, to some degree, having been an entrepreneur at some level. And number two, really knowing how to work with the board, work with the management team, and get to the right place on who should be on the board and who shouldn't be on the board. Again, it's a process. And I feel that some people are very good at going through that process, and they have an ability to do it. We see and get phone calls probably every other week from other stockholders who I would say almost 100% of the time were not invested in the company. And, they may say, hey, we're interested in, they own shares in the company, and, they believe the company's not doing the right things, and we're interested in going on the board. What would be your advice, et cetera? It's hard because there is some intangible in there that I can't really put my finger on what allows people to go from A to B. It's hard, needless to say. It's hard for me to identify that.
I guess the bad activist situation also has evolved over time. I think if I go back to when activism was relatively new, a lot of the demands on management were very short-term focused and not necessarily in the long-term interest of the company. And I think there were some very valid complaints at that point in time. I know a fair number of activists. I've run roundtables with a number of them, and I think on average, the thoughtfulness and the time horizon of the activist is completely different from what it was in the early days. And I think it's you don't see that many situations where you say, wow, why would you demand that from that company? You just whereas that was pretty common in the early days. I feel like it's a much more thoughtful
It's a great
area.
point. I feel like folks have really, even the management teams, most of the management teams, I mean, there are some spaces that we're relatively well known in. There are other spaces where we're less known. But what we find is that the companies or the spaces where we're relatively less known, believe it or not, there's a lot of folks on those boards and management teams that will call the places that we're well known in and say, hey, tell us about James. Right? Tell us about JCP, his firm. What does he stand for? What's his mission? Right? And that's it's important to us that people know that ahead of time. They understand how we think, what our focuses are, et cetera. Because if they don't, Greg, I mean, it wouldn't be a surprise to me if somebody hadn't done that work, but knew that we like to invest in companies, we like to be involved, and the first thought they have is to 1980s, 1990s activism, right?
Yeah.
That's the first thought they have. That world has it. There's still a couple of operators out there who are in that world, but that world has largely dissipated. Companies should say to people that operate that way, hey, you know what? We're okay. We don't need any help. We'd rather not have you. And I have actually gotten calls from management teams who we know, who we love working with. And they've said, hey, do you know so-and-so, or do you know XYZ, and kind of how they operate? And, I'm a big fan of promoting those that are doing it right.
Good. Yeah. Are there any really interesting case studies that the audience would find interesting?
Well, let me ask you a question. If there was a case study that wasn't mine, we've done this now for 15 years,
That's fine.
and some of the areas that I like looking at are areas where a founder or a former founder or potentially an entrepreneur buys a big stake in a company and then makes change happen. It goes without saying, everybody loves following what Warren Buffett does.
Mm-hmm.
And his case studies, the American Express case study, nobody thinks of it as activism, but he bought 4.9% of American Express back in the late 1950s, early 1960s. American Express was going on. They had a scandal, and the stock was declining precipitously. Interestingly enough, the stock at the time, it was not a C corp. The stock certificates were assessable. So the definition of assessable means that, this sounds crazy, but if the company were to implode and there was an issue, the stockholders would actually have to put up money. And so, because the stock was accessible, they later changed it after this whole saga. They changed it to be a regular C corp with non-assessable stock.
Mm-hmm.
What is relatively unknown is that during a court proceeding and under deposition, Warren was called by the CEO and asked to come be deposed and defend the company. And he, the CEO, having gotten to know him, understood that he would be a perfect person for that. And he ended up going to court, getting deposed, and being a part of the reason that American Express was able to push back this very large liability. So while it wasn't your more classic activism, it was working with the management team, potentially
Mm-hmm.
working. I don't know if he worked with the board. I do know that he exchanged letters with the CEO. I do know that he was deposed for it. But working with the management team, helping the company get out of a bad situation,
Mm-hmm.
that was neat for me to read. And the fact that it was done. I mean, this is going back 60 years now.
Mm-hmm. Mm-hmm.
But I think there are so many case studies. I'll add one more area that I would encourage absolutely everybody who's interested in investing, activism, business in general. The 1800s, Russell Sage, Rockefeller, Vanderbilt, all these folks, people consider them, kind of businessmen, entrepreneur. They were also great stock market investors.
Mm-hmm.
Many of them would, Russell Sage being somebody that not many people have done work on, but when you think about our railroad systems that have been built across the country, he would buy stakes in railroads and help them grow through his financing arrangements.
Mm-hmm.
It was just very, very cool. So,
Hmm. Yeah, that's really great. So let's look forward. After talking about the 1800s, what do you expect the future of activist investing to be? How do you think it'll evolve?
yeah, my take is that people are going to move towards this area of helping companies get into the right capital structure with the right growth and getting right people in the right seat.
Mm-hmm.
I don't think we're in a place anymore of buy shares and try and get the company to do a strategic alternatives. While that might be a minority set, one out of every 20,
Mm-hmm.
everything else is going to move towards this growth activism mindset.
Mm-hmm.
The active world in comparison to the passive world is, even though you're seeing more proxy votes and letters today, et cetera, than you were last year or the year before, I actually think you're seeing less and less people. What you're really seeing is you're really seeing more passive investors being okay with being more public on their investments. You're not seeing as much in the way of new fund formation, new investment firm formation around activism. I think it's become harder. I think companies are more skeptical. Which, don't get me wrong, for those that aren't focused in the right areas, it's the right way to be. I do think it's become a little bit more that way, but I think it'll push that growth activism direction, which is our focus.
Yeah, no, that's great. I mean, I think with the preponderance of sort of ETF tracker stocks where people just track an index, it's kind of necessary, right? Because such a small percentage of the total investment is actually thinking. They may as well be very active to make up for the fact that so many are just sort of idly owning an index. So I think it's definitely a trend that's here to stay.
As I said to an institution the other day, we are the G in ESG.
Mm-hmm.
Like we focus on governance,
Mm-hmm.
and that is an area that I think every institution should have in their portfolio, just to be able to say, hey, you know what, this is an area that for our constituents we're focused on.
Mm-hmm. Oh, that's great, and I think that's probably a great place for us to wrap up. I really appreciate this. We've been speaking with James Pappas. Thank you, James, for joining us for this very important discussion.
This has been fantastic. Thanks, Greg. Have a great day.
Thank you. You too. You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.